Um, is there a way I can share my screen?
Yep.
There we
Should
go.
be have access for that. Just if you hit the share button at
Perfect.
the bottom. There we go.
Yeah.
We see the full
Let,
presenter mode.
you can see this?
Yeah, but it's showing you what you see on presenter mode. So let's see.
Okay. Well, as long as you can see the slides,
Yep,
that's perfect.
we can see it.
All right. Perfect. So my name is Chirag Ved. I'm a general partner at Cronus Ventures. Before I get started, I'd like to thank, Spencer, Taylor, the Summit team, Hannah for having me on. Yeah, I'm originally from the Seattle area. I worked at Microsoft for a couple of years in a few different business roles. Spent the last 6 or 7 years at an investment bank called Evercore. I've been around the startup community for a decade, decade and a half, helping sourcing opportunities, advising a large number of companies. And I'm proud of all the work that I've done, but also that all the great entrepreneurs around me have done. It's truly an incredible seat to be in because I don't think, I don't think you can learn more in any other category. And so today I'm here to talk about something that a lot of people have questions about: how to prepare for investor meetings, what investors are actually looking for, and how you can frame your story properly to fit that mold. And I'll use one real company as an example throughout just to help with that. So just a bit about the firm. Cronus Ventures is a boutique venture capital firm founded in 2000, and we tend to be very active at the pre-seed level. Sometimes we're first money in, but more often than not, we're part of that first round. We're part of that first round, and over time, we work to become advisors and support teams through their development. On the slides, we talk about 6 different categories that we invest in: AI and AGI, defense technology, cloud AI infrastructure and governance, increasingly token optimization, agentic AI, cyber, and we do have a number of investments in India now, which has been a category of interest to a few of our partners. So I won't spend too long on this slide. I'm going to use CoreStack as an example at a few points throughout. It's one of our portfolio companies. We invested in 2017, and it's currently at a 9-figure valuation. I think just to start, right, the way they got their beginnings was by offering a pilot to a large telecom MSP. And just right off the bat, they were able to cut that customer's Amazon cloud bill by 40%. The customer came back with even more requirements, which CoreStack fulfilled. And that was what they needed to get traction, even before they had any provable metrics off the bat. So without further ado, I'd like to get into the framework that I look at. And I'll caveat this by saying that every VC you talk to will have something slightly different, right? Just a different approach to what they look at and how they think about the landscape. But in general, especially at the early stages, which is what we focus on, it's some version of 3 things. It's one, what problem are you trying to solve, and is it a problem that's actually worth solving? 2, what is your proposed solution, and are companies actually going to buy in? And 3, why are you the correct team to be building it? So let me talk through all 3. Right? First, the problem. Is it painful enough for you to acquire customers? Right? There are a lot of problems in life, and most don't require you, and the majority can be solved without building a technology company. So is it worth solving, and how? And the piece I think matters most is, what is the status quo? What are people doing today, and how are you differentiated? So at CoreStack's founding in 2016, we just started talking about multi-cloud. Enterprises were deploying workloads on AWS, on Azure, and Google Cloud with no way to govern them. And that status quo was expensive and painful and made it a legitimate problem to solve. All right, now the solution, right? Why would anyone switch from the status quo? Is it inconvenient? Is it painful? Is it arduous? I mean, if we look at the biggest enterprise customers on software platforms today, Most will tell you that they don't really like those platforms, but it would be a major pain to move off of them. Right? Oracle databases retain in the high 90s. Citrix, right, has extremely high retention despite being a company for decades. So how do you really enter the market and what's your wedge? Second, have you actually worked towards product market fit? That could be letters of intent, could be pilots, could even be customers that have tried your product and iterated with you that are now converting. Either way, validating your solution is extremely important. And then third, the team. Do you have the right prior experience? And the real question, right? Because startup companies tend to pivot 4, 5, 6, 7 times before they have an idea that takes off. Can you pivot if that first idea doesn't work? Beyond operating the company, one of the more important things that founders actually have to do is fundraise and land customers. So this is a key point for me at the pre-seed level. It's fantastic if you can raise the pre-seed round or even the seed round, but can you grow at the Series B level, at the Series C level, manage 100 employees or more, and keep impressing investors when expectations are high? So now a few other factors that I'll gloss through. I mean, you've all heard about market sizing, and in every presentation you've seen, everyone will come up with a big number to demonstrate that there's a TAM or a total addressable market of X billion dollars or more. But there are a few things that I really look into here. Is it a large enough category? What is the catalyst that makes this a viable opportunity now? And is this a growing market or is this one that's being created right now? If it was buildable 5 years ago, maybe be ready to explain why it didn't happen back then. Next slide. So there's two ways to really break down that market, right? There's a bottoms up analysis and there's a top down analysis. I tend to prefer bottoms up because what you can do is you take the total number of addressable organizations you can service or your number of users and build your revenue projection price times quantity. Essentially, what you charge per unit or token multiplied by how many units of that you can sell. And then what that does is you have levers that you can actually pressure test because investors and your own management team should look at how that model moves with more organizations and more revenue per customer. Every input there is testable, and that's very, very powerful. Great. So next, I'll just talk about some metrics, right? Every industry has metrics and headline numbers that are relevant to them. So you have to figure out what yours are, make sure they're displayed properly, and most importantly, make sure that they're trending in your favor at the time you're having these conversations. Startup metrics will fluctuate. Not everything is rosy, but the timing is actually extremely important. It can change your outcomes pretty significantly. Right. So these are four categories that a lot of you are building in. These are just sample metrics that I've put on here: pilot to paid conversion, ARR growth and burn multiple, et cetera, et cetera. But find a couple that really resonate for you and your industry and make sure that you've illustrated them well. So let me just move ahead to moats over here. Now, a theme I think is really important is defensibility. And what was defensible in the past, and by past I mean 2 years ago, may not be as defensible today. Right? So you start with technology. People used to value an algorithm that was 2 years ahead of its time. And that's still valuable, but now you can get more done in a weekend than your team used to be able to do in a month. So in my view, I think the moat has really shifted from algorithms to data. What proprietary data makes your systems better? Switching costs. Customers used to stay loyal because they didn't want to switch. Today, I think you want to sit in the right path. Migrating off of platforms is easier than ever, but if you're plugged into every tool that they use, there's no reason to. An example of this is Salesforce headless agents, right? They're opening up their whole platform to other tools. Economies of scale used to mean that unit costs fell as volume rose, and that's not as set in stone anymore. So really, I'd look at gross margin after inference and after AI costs that you're incurring. And brand. Buyers still have to trust you, but the real answer is being where the buyer already works. It can be as simple as MCPs, or you can make it as complicated as you want. But the key point is having plug-in and tie-in to a workflow that companies are already using. So I think the last piece on metrics and broader themes is go to market, right? There's no right or wrong way to do this, whether it's product led, sales led, channel and partner, or community led. But just make sure you're communicating what you've done and what your plans are. Founder led sales are fine at the beginning. The question becomes over time whether someone else can run this motion. Next, know exactly what you're asking for. How much money are you raising and why? Many founders make this number up. That's completely acceptable, but tie it to something. Companies X, Y, and Z in a similar ecosystem raise this much at this valuation. It is good enough, right? Know what you're raising and be able to communicate what you're using it for. Second, the runway. Communicate how much time this money will last you and what you're going to achieve as a result of raising it. And finally, the cap table. And make sure the friends and family rounds ahead of time have been clean, that no complications have come up in diligence, and you've already figured out what dilution looks like for you. And having all these three pieces together will make you look more credible when it comes down to presenting it. One slide I think is really interesting is to just frame what venture capitalists are actually looking for when they deploy capital out of a fund. Right. So I'm coming up with a hypothetical example here that if a venture capitalist has $100 million fund, at minimum, they've told their investors that they plan on tripling it. So that means 100 million into $300 million over the lifetime of the fund. And now say that they write 10 checks of $10 million each. Now we all know in venture capital, the majority of returns come from a couple companies. So out of those 10, let's assume that two of those give you that entire return that you're looking at. All right. So in those two instances, that $10 million check needs to come back as $150 million, which is about a 15 times return on what they put in initially. And if you assume 10% ownership, I'm not even factoring in dilution here, you need that company to then grow to 1.5 billion, right? You need that company to become a unicorn. So when VCs are looking at deploying capital, they're trying to figure out, how much scalability that company actually has. And that's really important as you consider your storytelling. Now, I also want to note that there are other ways to fund the business, right? Venture is not the only way. Bootstrapping is becoming increasingly popular today. I know a lot of great entrepreneurs that are trying to operate their companies at profitability and avoid raising. There's venture debt, revenue-based financing, and then you have grants and non-dilutive financing, which is, increasingly popular in the defense category today. I did promise a list and a checklist to the summit team. So, here's the list. I'll pause really quickly to give you a chance to look at all this. A couple things I'd flag on this page are first, making sure that you have a defensible moat, or at least a reason that you're around as a company. Second, your key metrics, what you measure success by. And third, having a really good answer for why now. Right? Why wasn't this buildable before? And why are you doing it today? And now I have a list of 8 questions that you'll probably hear in some form. How do you know this problem's urgent? Why now? Why didn't this exist 5 years ago? And why won't the incumbent just build this? It's a very popular one nowadays when a lot of different product development projects could be features in Quad. So number four here interests me the most because coming from a finance background, I see projections that model revenue from zero to $300 million in 5 years. Which is fine. I think we should all be aspirational, but when you present, you should think about what that means for your cost structure, right? You need to factor in higher costs on technology, on spend, on consumption for your employees. Uh, and so just think about that realistically. Think about what that scale would actually mean for your company. And seven is something that we maybe hadn't touched on earlier, but when you do talk about your use of funds, clearly outline who your next hire is and why that role. I mean, it shows that you're being responsible with the proceeds and you've actually thought through what needs to happen for your company to grow. So after you meet a VC, right, I've heard that it takes 7 meetings with a specific VC firm to raise money from them. I mean, it doesn't take us 7, but your primary goal from that first meeting is to make sure that there's a second meeting. And what usually happens internally is, the partners get together about once a week and they talk collectively about the companies they've encountered. If they're interested, they'll ask follow-up questions to diligence you further, and then they go to a term sheet. The thing I'd really emphasize here is that your biggest leverage point is momentum. I would really encourage talking to as many different firms as possible within the same couple week time span and to run conversations in parallel. Number one, it signals urgency and it gives you a reason to check back in frequently with investors that you've just spoken with. And secondly, probably most importantly for anyone that's actually building, spending a year fundraising doesn't help you build the best product or find the customers. I mean, it should be a part of your cycle, but it shouldn't take up all your time. Just to wrap up, one, right, understand where VCs are coming from. Two, understand your company and your category cold. And three, defend your moat and make sure you're communicating that properly. Thanks so much and happy to take any questions that you might have.
Thanks, Chirag. That was awesome. We'll open it up for questions now. And while we're doing that, Chirag, can you just put up slide 19 again?
Yeah.
If you've got a question, you can come off mute or you can put it in the chat. Let me just check and see here. And yes, Mohan, we typically share out the slides.
Yeah, I'll send it. I'll send it to you afterwards.
Awesome. Let's see. Matt asked, in your venture math example, over what time period does the VC expect to reach that billion plus in EV?
Yeah. I mean, venture funds used to have a 5-year life cycle that's probably turning into 10. And those numbers are continuing to go up because companies aren't going public and they're not seeing the exits they used to. Um, so yeah, it's probably a decade if you think about it. But this also, right, this also gets impacted by what stage that venture capital firm is at. So if you're a pre-seed investor, you fully expect to have your capital deployed for a much higher number of years. But if you're going into Series D or E, your companies have a higher chance of success than probably 10 or 20%, but you're probably not making 15%, 15 times on that investment.
Mike had a question about suggestions, let's see, for ways to incentivize key employees without giving up equity.
Like, give them money.
Yeah, yeah, that's at the end of the day, everyone will need some form of compensation, right? Whether that's equity or money. If they really believe in you or the vision, that can be very compelling as well. And that does work for a lot of early employees, but even then they'd probably want to be compensated through equity. So I'm not sure that I have have a great answer to alternatives there.
Yeah, that's fair. Rob asked, beyond capital, how do you typically help your portfolio companies grow?
Yeah, the main thing that, most of Cronus's partners have worked at Microsoft, and at least for us, we're pretty plugged into the tech ecosystem here. And we enjoy working with our companies and helping them with whatever they need help with. Generally, that's been making introductions to potential customers, making introductions to the large tech companies that all exist here. But can also go further. I mean, I've personally worked with companies on helping them get their first couple key partners, fixing their pricing strategy, their marketing strategy, and even with contracting. So that's a fair point. I think everyone should ask their potential investors what value they can bring to the company and make sure that all of it aligns with what they need help with.
Awesome. I know I'm hitting some of these out of order. Sorry, everyone. So, okay, Arjun asked tips on getting the first meeting through cold outreach. He wants to know how you can stand out.
Warm intros are generally the best way to do this. There's nothing wrong with cold outreach, but going through a connection, even if it's a mutual connection that hasn't spoken with the individual in a while, can be a lot more powerful and a lot more meaningful. I think especially in today's world where uh, cold outreach has become somewhat democratized by all these AI tools, I've seen response rates go down pretty significantly. So if there's any way to do it through someone through a mutual connection or through being part of a mutual organization, that's usually the best way to try to approach it.
That was our experience at Summit with, and we don't have an LP relationship with Cronus, but we met your dad through
Yeah, yeah,
an event in Seattle, which, it's another important thing to do is show up to events, right? And meet people in person. And then your dad introduced us to you. We've had a couple meetings today. You met Devin, one of our portfolio operators. So you just kind of see it just keeps evolving, right?
yeah. That's true. And if you're in a city like San Francisco or New York or Seattle, Chicago, Austin, you have startup meetups every single day of the week. You don't need to go to all of them. I'd recommend going to some of them. And if you don't live in a city that has events, I would recommend taking out some time, at least to whatever extent you can, once a quarter, to visit and show up to some of these.
Um, Eric Espinel, do you want to just come off mute and ask your question? You've got kind of a long question in there. Thanks,
Yeah,
Eric.
sure. Sorry about that.
You're good.
Yeah, so I'm just curious with LOIs. I think first off is how do you value or discount LOIs when assessing like pre-revenue startups and startup traction, and then um, understanding a little bit more about how you differentiate between LOIs that are truly high signal versus those, it's easy for someone just to say yes with an LOI because there's not really skin in the game. And if they really do, from what I've heard from some VCs, is like LOIs are kind of done for. They're not really that important now, given that product building is so easy and it's a lot quicker to start take an idea to prototype. But just wanted to get your perspective on LOIs and stuff.
Yeah, I think an LOI does demonstrate that you've at least put in a level of preliminary work in getting to know a customer, getting to know what they're looking for, and in getting some sort of validation from them. I do agree that it's not as powerful as it was before, yeah, but it's much, much better than not having anything. And I'd still view it somewhat favorably. I think there are a lot of follow-up questions that'll then come from firms, right? The questions will probably be, what's the nature of your relationship with that customer? How long have you been speaking? Can you describe, the depth and magnitude of these conversations? what are your expectations in terms of how and when this will convert? And then you should expect those investors to hold you to that. If you say that this should convert in the next 3 months and it doesn't convert, then it'll probably bring up some questions. So, long story. So, in short, obviously not as good as having revenue coming in, but it's much, much better um, than not having the LOI in hand.
That's helpful. Thank you.
Yeah.
Devin, you want to just come off? Oh, you're already off mute,
Yeah,
man.
yeah, I'm
Ask
ready.
your question.
Chirag, thanks for the presentation. I think some great reminders. Um, can you talk through how we should handle or how we could handle when a VC goes silent during diligence? How hard to push, when to let it go? Just some best practices around that.
Oh man, that's it's a challenging question because everyone will have uh, a different personality, right? And they'll have a different way of responding, quite frankly, to this, right? I think ghosting in general isn't very professional, and I'm sorry that people go through it and that we all go through it at some point. What I would say is that following up is great. If you're in the process of actively fundraising and you're engaging with multiple folks, I mean, you'll have to follow up anyways, right? And you should follow up that, hey, with updates on how things are going in your process. And so I think that you should definitely follow up because emails slip, and I wouldn't have a problem with sending two, three, even four follow-ups. But I generally try to tie the follow-ups with some kind of an update, either an update on how your fundraise is going or an update on things that have evolved in your company. That you've had this very promising conversation with a partner, you've just onboarded two folks, you've built this product out, you've gotten this new customer, you've received an LOI. I mean, those are all natural touch points for you to reach back out. And so unfortunately, sometimes emails do go missed. But if you provide updates, you can bring them back um, pretty frequently to the table to have conversations. And another point that I just highlight is, if you can frame the conversation in such a way that to interpret what the silence means, that hey, is this something you're interested in doing in general, or is there something that we can do or provide that can make you feel more comfortable with this idea? Uh, that gets rid of a lot of the uncertainty. Either way, posing a question like that can push them to make a decision.
Thanks,
Great
Devin, for
answer.
that. I'm going to take Taylor's question and flip it upside down. So, Chirag, I mean, you've shared some of the essentials of the communication and what to put forward, but what are some clear standout items? And it could be the founder, it could be the deck, it could be the story. But what are some clear standouts in your mind that just are impressive to you?
At the earliest stages, I think the team is probably the most important thing that you can put together because it's very rare for a company at the angel or pre-seed level to maintain operations in the exact same way when they're a larger company. So having a team that has proven experience in the industry, that may have even worked at the customers that they're trying to service, um, that's demonstrated that they have the ability to pivot and they have key relationships is probably the most important piece. I'd say as a company gets more and more mature, focus will start shifting onto the company's operating model. And then the question much more so becomes, what's the company doing well? Who are the key pieces that you have in place, and what's the strategy here? At the very beginning stages, it usually comes down to the team. And if the team is younger and if the team maybe doesn't have the same decade or 2 decades of experience as some of the other founders do, then passion, charisma can really resonate. And you having, being able to identify a key problem and a key solution and being able to run at it will also land quite well.
Terrific. think we've got time for one or two more. Let's see. Eric asked a question about biotechs, facing a longer runway and needing much more capital to get through all the regulatory. He said, how do long-term runways change what VCs look for?
I'm unfortunately not very familiar with biotech, but I can answer that question in the context of longer runways. Um, I think some VCs are patient and some VCs aren't as patient. And so if you can identify venture capital firms that have portfolio companies um, that demonstrate their willingness to stay patient over the longer term, those are probably the ones that you should target at that point. So I think that's point number one. Point number two is I would start looking at non-dilutive financing options as well. There are funding sources outside of venture that can help you get through that cycle. Um, and then I'd say number three is try to build as lean of an operation as you can to get there. I mean, I also caveat that and mention that biotech investors probably understand that dynamic too. Maybe it's just something I'm not as familiar with.
Well, I think in the opening statement you made, like just aligning what you're looking for, if you've got a biotech, probably shouldn't be pitching Cronus.
Well, we actually do have one or two partners that understand biotech and medtech,
Okay.
and so they'd be happy to take a look. But yeah, knowing exactly who to approach is important too.
Better said. Yeah, thank you. Awesome. All right. If anyone's got the last lightning question, come off mute. I'll just be silent for a second here.
Do you have any suggestions how we can make the due diligence process as frictionless and easy as possible for pre-seed companies?
Yeah, what I'd say is try to anticipate all the data requests that are going to come in. And that can be as easy as just asking Claude or ChatGPT to give you a list of all the things that VCs will probably ask to follow up on, and just having that set up in a Google Drive or a OneDrive off the bat. And you can have different stages of it. You can call them data rooms, right? So have like a stage one data room, a stage two data room, and to whatever extent you're able to have this pre-populated, I mean that'll definitely make things more frictionless. Now, I
And
probably wouldn't share the stage two or stage three data rooms with folks that haven't expressed that level of interest, right? For many reasons, but it's always good to have that.
do you usually sign NDAs once you get to stage two or three?
We generally don't. Some folks might. I think it just depends on how proprietary or not what you're working on is. And the issue with NDAs is that, right, there are a lot of there are a lot of technology companies in the ecosystem. Ultimately, when you talk about operations and customer acquisition, there tends to be overlap there too, and that just makes it difficult. What I would say is most VCs, I won't say all, but the majority really do use professional discretion and will use information to make themselves smarter, but will never share
Good to know.
the
Thank you.
best practices and lists of their portfolio companies.
Thank you.
All right, we'll go to Eric for the last question. Go for it, Eric.
Thanks, Spencer. I just quick question on ICPs. How defined do they need to be, especially given that most of the time you talked about like the evolution of a startup, and I'm assuming they will evolve quite a lot from the time that they engage with the VC. How defined does it really need to be for you to invest in them?
Yeah, it should be somewhat defined. You're building a product, or if you're building a product, at least at the point of conversation, you should have an idea of what that final product looks like and who the ideal customer would be for that product. Now, if things change, that's fine, but then you just have an updated view of the ICP. Um, I think in today's ecosystem and in today's market, it's really tough to build without knowing who that customer is or without engaging with that customer while you're iterating. And so that's probably the best piece of advice I have. Things are going to change, right? At the pre-seed level, we completely understand that the business you'll have in 2 years it will likely be different from the business that we're investing in today. Um, but communicating what you're working towards at the present point in time is extremely important.
Got it. Yeah, the question was framed around the idea of I'm starting an AI infrastructure
Okay.
business, and so the infrastructure can really serve all sorts of different customers, and we're currently in the process of finding design partners to help button up our ICP a little bit more, but
Yeah.
figuring that out, given that we're infrastructure for all sorts of the possibilities are quite limitless, so it's kind of been challenging to nail it down.
So the best way to frame something like that would be here's the universe of customers that we can serve. We're starting with category A
Mm,
because we have relationships here, because they've resonated with us, or maybe list another reason for that. Then say after category A, we're going to approach categories B and C. So I think that's a good way of framing it.
yeah, it's helpful. Thank you.
Yeah.
Didn't know I muted myself. Thanks, Chirag, and thanks everyone for the Q&A. It's an important part of the Midday Connect. Yeah, if we can get the slides, then we'll share those out. And you all are welcome any Tuesday, same time, same place. And thanks again, Chirag.
Thank you for having me.
Have a great rest of your day, everyone.
Thank you.
Thank you.